Hey everyone, Chris Carr here with Freedom Home Loans, now powered by American Mortgage Solutions. I'm coming to you today with our January 2023 monthly market report. I'm going to go over a handful of things in this month's report to include an update on supply and demand, why this is becoming a competitive advantage and a big opportunity for the educated and informed buyer, real estate agent, mortgage professional, homeowner. Touch base on mortgage rates, the home price update, and well as talking through kind of the confident person versus the confused person in today's environment. So if you know anyone that could find this information useful or helpful, or if you find it entertaining or informative yourself, please share it with 3 people that you know. And also don't forget to like and subscribe. So I'm going to jump into the January 2023 monthly market report. And I'm going to start off here by going into the supply and demand. Now, inventory levels are increasing. Supply is going up. More homes are for sale or available. And buyer demand has decreased over the past 6 to 9 months. So how that works as an economics major in college is pretty simple: supply and demand, right? It's a shift. It's transitioning from a seller's market to a buyer's market, and this is an opportunistic time for the educated, like I said, buyer, homeowner, real estate agent, or mortgage professional. So let's touch base on mortgage rates. Now, as you can see, the 30-year mortgage has doubled in the past 12 months. In the past year, we went from 3.2% to 6.4%. That is the first time it's ever happened in the history of mortgage rates. All right, so it has doubled. Home ownership has got more expensive, right? Rates have gone up tremendously in a short period of time. If we look at going back 50 years with the 30-year mortgage rate and comparing that to the 10-year Treasury yield, the average spread over that time has been 1.7 points. Okay, so that's a good comparison historically with where rates should be. If we look at what happened during the pandemic, we were at 1.79, so slightly above that average, right, between the 10-year and the 30-year mortgage rates. If we look at where we're at today, it's a 2.79 gap spread between that. So mortgage rates are around 6.5%. If we look at today, if there was a normal spread, we'd be down to about 5.5%, right? Which is a pretty typical interest rate historically. It's a pretty good interest rate historically. So why are mortgage rates not 5.5%? Let's dig a little bit deeper. So as panic has set in over the past 12 months or so, right? The first 6 months of the year were pretty good. If you remember back in June, the Fed said they don't have the inflation under control. They want to reset the housing market, and they're effectively doing so. Pretty much since that time, there's been a big shift, and the spread over the yield, the 10-year yield, has increased the 30-year interest rate all the way up to above 3%, right? Now things are starting to come down since November. I think rates have steadily gone down since around September. I think November they kind of peaked, but overall they've been trending downwards since September, October. If we look at the 50-year average, right, 1.8, and look at that trajectory, we can see we're now kind of on pace with the increase over the year. However, that sharp, steep incline was the Fed really trying to get things under control. And when the Fed wants to do something, ultimately, they do it. They wanted to reset the housing market, and congratulations, they've done so. But ever since we've kind of got inflation under control, we've seen that spread decrease, but there's still a 1% difference. All right, there's still a 1% difference or gap in that 10-year to 30-year interest rate. If we look at the mortgage projections over the next year, over this year, we look at Fannie, Freddie, MBA, and NAR. The average of all four, all of them have rates going down and subsiding somewhere between 5.5% and 6.2%, with an average of 5.73. Okay, so rates are coming down. Now, as I discussed, this is a very important time to understand the difference between a confused buyer and a confident buyer, right? Confused people don't make decisions, right? The confused buyer doesn't buy. Confident people make educated and informed decisions and take advantage of opportunities. Okay, Lawrence Young, chief economist of NAR. The upcoming months should see a return of buyers as mortgage rates appear to have already peaked and have been coming down since mid-November, like I discussed. So be advised, David Stern says this may be the one and only window of the next few years to get into a buyer's market. And remember, as the Fed data shows, home prices only go up and always recover from recessions, no matter how mild or severe. Long-term homeowners should view this market right now as a unique buying opportunity. Okay, David Stevens was also on the chair at the MBA, on the board at MBA. So very, very educated person, right? It is a unique opportunity if you understand and use data and information to put you in a better position to make a better decision. So let's go to the home price update real quick. Home price forecast by 2023 by source. The only thing we can tell from this chart here is that nobody agrees. We don't really, we go anywhere from a 5.4% appreciation to negative 5.1%. That's a 10.5% swing, right? So really, there's a lot of unknown, right? No one knows if it's going to go up or down. Overall, it's going to be about, probably pretty flat if we take the average of everybody. The average of all 7 forecasts results in no appreciation. But if we look at the home price appreciation pre and post pandemic, we can see that the appreciation before the pandemic, 17 to 20, was 12%. Pretty decent, healthy appreciation, about 4% per year, pretty good. We look at the 2.5 year period of the pandemic, all the way up to 2022, when rates started to come back down and the Fed said that they didn't have it under control. If we take a look at that, appreciation was 38%. So would it make sense for the appreciation to come down a little bit off of historic highs in such a short period of time? Absolutely. Okay, we've had 50% growth in the past 5 years. That's pretty phenomenal for appreciation. Some prices should come down. They're not at healthy levels because it was bumped up due to several factors. But of course, house prices should come down. That's not normal. If we look at the percentage of homes with price reductions year over year, this data goes back to November. It's usually trailing about a quarter or a month or two. You can see that 1 to 1.2% have a price reduction year over year. I would say that's increasing, just being in the market here a couple months later, especially going through the winter, right? Typically a slow time, typically more drops through winter periods, but not a significant number. My question would be, have home values hit bottom, right? Have we already bottomed out, or are we at the bottom right now, right? Are we at the cusp, at the turn, at the bounce back, the floor? Are we there? If we take a look at month over month change in home values from the 4 major indices here, we can see that we've gone to a low. Each 4 of these indices here have gone to a low and steadily came up from that, right? From -1 to -0.5, from -0.7 to 0, and further down the line there. Now, it'll be important to see what happens with the data coming out from November and December, but I think we're pretty close to a bottom personally. You can never time the market perfectly, but if you're at the bottom 99% of a turn or a growth period, that's a pretty good time to get into the market. So we must control the narrative. All right, over 11,000 houses sell every day. It's 4 million divided by 365. That's 1,000 houses sell every day. That's 8 houses a minute. So during this, whatever, 5-10 minutes we've been doing this, 40 to 80 houses have sold in this short period of time. All right. So houses are still selling. What the educated and informed buyer, agent, and loan officer are doing is suggesting alternative means of financing and really keeping an eye on buy down opportunities. There's 2 kinds of buy down opportunities. It's going to be permanent and temporary. Permanent buy downs are where you permanently buy down the interest rate, and temporary buy downs are where you mostly use seller concessions, which is a great negotiation point and what's going on in today's market, where you can temporarily get the interest rate lowered. I closed a loan this month in January where the first year payment was $1,200 a month less because of a seller temporary buy down. Okay. Temporary rate buy downs are a hot trend for mortgages as borrowers face higher costs for home loans. Some buyers are exploring alternatives to traditional mortgages like ARMs, non-QM, bank statement loans, things like that, in a period of rising interest rates that is expected to continue into 2023. More people are looking for alternative loans. Buy downs are a less costly alternative to traditional fixed rate mortgages. My advice right now is to plan on rates coming down in the next 6 to 24 months if you have a solid career, good position in life, and you feel comfortable about qualifying for a refinance in the future. Okay, so there's a balance there with how much you buy it down and what that break even truly is. If we look at the lending standards, they've actually tightened through COVID, right? Lending standards have actually gotten more stiff. If you look at the housing bubble in 05, 06, 07, there was no standards, right? There was no credit was available to everyone. A rating of 868. That's absurd. 8 times riskier, more than 8 times riskier than it is today. Okay, so lending standards are still tightening. What do I think the biggest opportunity is right now? What is the biggest opportunity right now? Active listings are up. No surprise. If we look at 2021, almost 500,000. At 2022, about 750,000, 751,000 homes. Active listings. There's more houses for sale. If you look at the pending listing count, it's gone down every single month of the year. From January through November, pending listings have gone down. That means less homes are pending for sale, right? So they are moving faster. They're not sitting. Sorry, I got that backwards. They are sitting longer. The percentage of distressed properties for sale is almost non-existent. Again, almost non-existent, less than 2%. Okay? Average days on the market are going back to normal levels. 24 months or 24 days in November, right? I mean, that's still a pretty hot market. Okay? Months of inventory, homes for sale. We go back a little bit further to 2011. Months inventory, if you look still, I mean, minus the pandemic period, months inventory is pretty healthy. So what does all of this mean? What this means is I see the position that we're in right now as equivalent to like a turn on a racetrack, okay? So we've been going down the straightaway for the last few years. Everything's been easy. It's been go, 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 build speed, faster, 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 faster. Now, the educated and the informed buyer, homeowner, real estate agent, and mortgage professional, they make careers out of the turn just like drivers do, right? You downshift, you prepare, and you take your line, accelerate through the end of the turn to build up speed and momentum for the next straightaway. So there are more homes for sale. There are more homes are sitting longer. Pending listings are decreasing. Okay? What that means is there's more opportunity for the informed buyer to take advantage of this market, for real estate investors to build massive portfolios. I was very lucky to get into real estate in 2009 to 2011, right? At the cusp of this turn. We were able to change our family trajectory, make millions of dollars in real estate, and help other people make millions of dollars in real estate. The smart agent right now, the smart mortgage professional right now, is working on systems and people and processes to be able to hit the straightaway at full speed. The homeowner and the home buyer should be positioning themselves to make offers, to have seller concessions, to get a temporary buy down, to offer less than list price. Because if you're informed, you can take advantage of an opportunity. If you're confused, you are indecisive and make bad decisions. It's important to pair yourself with an educated mortgage professional and real estate professional or agent to make sure you're taking advantage of the opportunities and positioning you and your family in the right and best position to take advantage of just home ownership, buying multiple properties, or creating generational wealth through real estate. Now, this has concluded the monthly market report for January. I'm going to go through a couple slides real quick if you want to pause this for the 3 resource slides here that go in. But as I want to really conclude, it is important to position yourself right now to take advantage of life-changing opportunities. One thing to do is make sure you're fully pre-approved so that when you make an offer, you are in a position to close quickly. Motivated sellers want their problems solved fast. If you are fully pre-approved, pre-underwritten, all your documentation in, supported, and we have an automated underwriting decision of your loan that you are pre-approved, we can close loans in 2 to 3 weeks. We've had 3 clear to closes this month in 5 days, 6 days, 7 days, and 9 days. 4 within less than 10 days because we do full pre-approvals up front. If you want to offer lower than list price, if you want to have seller concessions, you want to strike when the opportunity is right, you need to be fully pre-approved so that you can match your terms with the ability to solve problems quickly. Again, if you found this information informative or helpful whatsoever, please send it to 3 people that you know. They could also find it beneficial. Thank you so much for taking the time to watch this January 2023 market report. Chris Carr, again here with Freedom Home Loans, powered by American Mortgage Solutions. Bye.